Welcome back to Uncontested Investing. I'm Tim Harris. Thank you so much for stopping back by. Today, we have a very, very special guest, my good friend, John Beacham. John, thank you for being here.
Hey, thanks, Tim. It's so exciting to be here. And it's beautiful, beautiful Austin, Texas, right in front of the Capitol building here. It's an amazing view, and it's great to spend some time with you.
Man, I'm excited about this, and I know Jeff Tesh is excited about this. We're not going to ask you to put your crystal ball on today, but since a lot of people out here don't know exactly who you are, would you take about 60 seconds and kind of just introduce yourself?
Sure. I'm John Beacham. I'm the CEO and founder of Toorak Capital Partners. Before that, I ran and was president of a company called B2R Finance. At Toorak Capital Partners, what we do is we partner with lenders across the United States and the United Kingdom who originate business purpose loans. And what we do is we're not the lender ourselves. We're the capital behind the lenders, and that we give them the credit guidelines, the credit criteria. They originate the loans. Then we acquire them a week or two after they've originated them, and then we hold them for our balance sheet. So to give you a sense of size and scale, since we started in 2016, we've acquired over $12 billion of loans, the vast majority of which are 1 to 4 family and small multifamily bridge loans in the U.S. and U.K. And our balance sheet currently is about $3.5 billion.
And John, just so the audience hears that was with a B, correct? I like to kind of stutter when I say billion.
I like the little mini-me thing, so it makes me feel a little better.
Do you watch Billions?
No, I've not watched it.
Great show. You got to watch
Everyone tells me I should watch it,
Yeah.
but I've not watched it yet.
For some reason, you are kind of wags. You are wags.
Hopefully he's a good character, so I don't.
Well, he's still in it 9 seasons later, so.
Yeah, some longevity.
And you got his personality. The first segment every week's bottom line up front. And the bottom line up front, I kind of like just ask the guest, spend 2 minutes, talk about the most important things that you're seeing in the market today, maybe things people should be doing, things they should be avoiding, just kind of the cliff notes of what we'll talk about for the next 35 minutes. Good to go?
Yeah, it sounds great.
Go.
So I think we're in a strange world right now, and that rates have gone up pretty significantly. Housing availability is very low, and so it's hard to find good deals as an investor across the country. We've seen interest rates increase significantly. We've seen construction costs increase, both labor and materials, and many people don't want to sell their houses, so inventory is low. So I think as an investor, certainly an investor looking to buy and renovate a property across the country, you're going to work double hard than you did a year ago to find the right deal, make sure it pencils out, not stretch too hard, but find a deal where you can buy that. You can buy it at a reasonable price. You have a margin of error in your construction cost. You can finance it at a level that sort of works for you, and you'll make a reasonable profit at a margin of error. And I think those deals are harder now than they were in the past, but they're still available. The best deals we see right now in this market are deals where you're taking something and converting it into something else, whether it's a single-family property turning it into a two-family property, whether it's taking a townhouse and building it into something bigger, whether it's taking 2 lots next to each other and knocking down 2 small houses and building townhouses on there. But the best deals that we see right now take a little bit more time, take a little bit more dollars, but ultimately end up penciling out better because you're fundamentally taking something and converting it into something that's better. So I would encourage investors to be really disciplined, make sure you're not stretching on deals that don't make sense, and don't think about necessarily what it is, but think about what it could be.
That was great. Now, John, I tell people all the time, you're probably the smartest guy I've ever met. And I want to just dive back from the Wall Street part of you at first and really so Toorak Capital Partners is named after a city in Australia.
Yep.
Where you used to jump out of airplanes, or maybe I like to let people know the entrepreneur that I bring on. And you,
Sure.
Even though you run a massive company, you're an entrepreneur. You've started multiple companies. You've run some big banks. Would you talk a little bit about where Toorak came from and maybe your entrepreneurial journey?
Sure. Well, I used to live in Australia a couple years out of college, and I was working in investment banking back then, and they said, "Hey, John, you're doing a good job. You can move somewhere if you want to." And the choices were at that time Paris, but I was horrible at French, and so that seemed like a bad idea. China, Beijing, I can't speak French. I definitely can't speak Chinese. So then it's kind of like I either go to England and Australia, and England seemed too like New York, so Australia was great. So I moved there, lived there a couple of years in a town called Toorak, which is a suburb of Melbourne, Australia, and loved it. It was just a phenomenal time. Did lots of deals there, traveled around the country. It was wonderful to be the exotic foreigner with an accent, which is not usually the role I play anymore, unfortunately, but at least I had some aspect of my life which I was at.
And then you went and worked for DB?
Yep. I was at Deutsche Bank for 12 and a half years in the commercial real estate group, doing large balance commercial real estate lending all over the United States. At the time, Deutsche Bank was one of the two biggest commercial real estate lenders in America. So that was cool. During the financial crisis, one of the last loans I made was a $2.5 billion loan to a large casino company, which is pretty ill-timed because apparently when you go into the great financial crisis, people gamble less. So the casino company went into bankruptcy. So I spent about 2 years in Las Vegas and Reno, really learning a lot about bankruptcy, fighting all the litigation, and ultimately taking over that company. Went the board of that company for a little while, which is sort of a whole interesting different podcast. But then after I was done with that, ended up getting calls from in 2012, people like Lou Ranieri and Blackstone saying, hey, we think housing prices are on the way up. This is right after the financial crisis, and it was pretty bad in the housing market. We want to go buy housing. How much you want to buy? 10,000 properties. What do you want to do? You want to buy them and renovate them and rent them out. And at that point in time, that idea of being an institutional owner actually renting out properties was something that was inconceivable, honestly. Like no one believed it. Even people in my company didn't believe it. And so I'm like, this is the best thing I've ever heard of. So I started a group within Deutsche Bank to go start doing this. Long story short, did about $5 billion in lending from 2012, 2013 to companies like Blackstone and 510 Capital and many other, Apollo and lots of other companies. And then ultimately structured the first ever single family rental securitization in 2013, which was hard because that was right after the financial crisis. Then started a company called B2R Finance, where I met this guy named Tim Harridge, amongst other people. And then built that up to about $1.5 billion of lending volume in about 2 years, doing long-term single-family rental loans, and then left and went through a personal journey process and ultimately founded Toorak Capital Partners, where I've been started in 2016, been running that since then.
So you were very responsible for the first securitization of rental home-backed mortgages.
Yep. Yes.
And then at B2R Finance, you created, structured, and originated the first securitization of what they called it, multi-borrower, which meant there was a bunch of us, not just Blackstone.
Yep.
And then you went off and created the first institutional company that was buying, I'm going to say it, don't cringe, hard money loans from investors.
No, we don't use that term anymore, Tim.
And now you don't buy hard money loans. You are continuing to evolve the industry, and you buy private lender loans.
That's right. And I spent a lot of time personally in sort of trying to get away from the hard money label because I think it really is not fair to our industry and doesn't really represent what our industry is about. So we prefer private lending loans or transitional loans or bridge loans. But fundamentally what they are is investor is buying a house. They want to go renovate that house, or it could be a small multifamily property and make it better. It could be, taking the same thing and just improving it. It could be expanding it, turning a one family into two family, lots of different versions of it. But fundamentally what we are doing is enabling the repositioning and sort of creation of housing across the country. And, we live in a world where we don't have enough housing. And so our business is fundamentally directed at sort of dealing with that housing shortage we have in the country.
So 10 years ago, next week, on October 23rd, 2013, I signed this consulting contract with this company. I'd never heard your name yet because you weren't allowed to be involved in anything.
Yeah, I saw another job.
Yeah. I got it from this Jeff Tennyson guy, who I'd never heard of, because I'd only talked to this Nick guy and this Allie girl. And then this Justin guy comes onto the call, and I'd never heard of him. But wow, in the 10 years, now the word DSCR is something that investors are looking for. And I'll never forget one of the first times I spent time with you in a boardroom in New York. You kind of looked across the table at me, and only the way John Beacham can. You go, Tim, a DSCR loan. And I was like, no, John, I don't. And you go, a DSCR loan. And I was like, John, I've never heard of that. You're like, I thought you bought thousands of houses. I said, I have. I've never heard of what you're saying.
Yep.
Maybe talk a little bit about, because it took some courage and vision to come into this industry that did not exist, with terms and structures and ideas that had never been done. Maybe just talk a little bit about the evolution and to me, it's the entrepreneurial process of creating something, but
sure,
your experience in that.
Well, a lot of things about being an entrepreneur is finding a hole, finding a market gap, and sort of finding a way to solve that in a way that's scalable and sort of profitable. And so what we realized was that in America at the time, that time is 2012, 2013, if you were an investor buying a 1 to 4 family property, pretty much the only lenders out there were ultimately funded by Fannie Mae and Freddie Mac, which are the big GSEs, or HUD, another government agency. And they would all underwrite that loan the same way, regardless of whether you want to go live in that house or if you were a landlord renting out that property, which to me made no sense, right? Like if you were to go buy a commercial real estate building that was the building we're in right now, or like a hotel or, office building or whatever, that would be underwritten based upon the rent of that property. And that was a very standard market, and that's how the commercial real estate market works. But for some reason, if you do the exact same house, have exact same business plan in a house, and you rent it out, you're not treated as a landlord, you're underwritten as a consumer. And that really didn't make a lot of sense to me. And if you look internationally towards the United Kingdom, where they have something called buy-to-let, or Australia, where they have a similar product, or even Canada, pretty much all the other major Western markets would underwrite rental properties like rental properties. They look at the rent, they look at the cash flow, they look at how they finance it. And we just didn't do that in this country. And so the idea was, let's go create a version of a lending product where we do underwrite it based upon the cash flow. Let's confirm there's a tenant in place. Let's confirm what the lease is. Let's confirm that lease is at market rents. Let's make sure that lease income is enough to go pay the interest on the loan the landlord is taking out. And let's go make sure that the landlord has enough liquidity to deal with times where there is no tenant in place. When a tenant leaves, you have to replace them, or you have to go repair or fix a property in the middle. And let's create a loan structure around that. So it's really about like adopting concepts fundamentally that either existed internationally or existed in commercial real estate and applying it to the single family and small multifamily universe in a way that hadn't been done in the past. And it's proven to be really successful.
Being from Texas and a bit of a redneck, when I first met you, I was like, I don't know if I can work with this New York. You lived in New Jersey at the time, but to me, you were a New Yorker.
Sure.
And I remember one of the times I was first talking to you, you went on this tirade about why single family was so attractive. And you were talking about most people grew up in a house and all that. And I think we had to tell that story for like 2 years in a row, but could you maybe talk a little bit about like why when you saw this hole, it made so much sense to you?
Well, I am by background, prior to that, actually not a residential person. Like I worked in the commercial real estate group. So what you learn as a commercial real estate lender is all cash flow. You learn about how to underwrite cash flow, what it means, how to validate rents, and on all those things that go into that. And so first of all, from my background, it sort of came naturally to approach this asset class from a cash flow perspective. What I still love about single family properties in particular, is that you have two ways out. And what I mean by that is you have a choice, unlike a hotel or an office building or industrial facility, which all have to be leased. The only way you can make money in that is to lease it out to someone else, or I guess own it yourself and occupy it. But most people lease it out. If you have a single family house, you have two set of buyers. You either have a homeowner who's happy to go live in that property, invest in it, and own it for themselves, in which they can underwrite. You can underwrite that based upon their personal income, or you have a landlord that can buy that property and rent it out. And what we saw during the financial crisis, where property values just imploded across the country, certain markets worse than others, but it was bad across the United States, is that at some point, housing prices decreased so much that it becomes kind of pretty simple for an investor to come in there, buy, rent it out, and make a lot of money off that. And so you have a floor. So I think single family is unique as an asset class because you really have two different and somewhat independent sets of buyers. It's interesting. If you look at Phoenix, for example, which is like the worst market, pretty much, maybe Las Vegas, depending on your counting, but it's pretty bad. In the housing crisis, even when housing prices there went down by half or more than half, rents for single family properties continue to go up every year during that entire period. And so that just goes to show you there's a big difference between housing prices and rents. They don't move in tandem always. So therefore, there's a big opportunity in this asset class. I think it's a lot more robust than most commercial real estate asset classes.
All right. That's a great point. I'm gonna stop and take a break and then come back and talk about property management because that's something that you and I have talked a lot about. Stick around. We'll be right back. At RCN Capital, we know that time is money. With our competitive rates and quick turnaround time, you can receive funding in as little as 10 days. We offer flexible payment plans to relieve the pressure of repayment process. Our team is experienced in making sure that you choose a loan that will suit you best. Get on the phone with the loan officer today by emailing info@rcncapital.com or clicking the link in our bio. Welcome back to Uncontested Investing. Tim Harrod, still here with John Beacham. John, I want to jump straight to, I think it was late 2014. We're in the office in Charlotte, and you were getting us ready for the first securitization. And it was, I don't know, Moody's, Morningstar, one of those people. They come out and they've got the residential managing director, the commercial managing director, the residential VP, the commercial VP, and then each have an analyst. So there's 6 of them looking at me, you, and Tennyson.
Sure.
And it was so funny. The commercial guy kind of got it before the residential guy. And then one of them said something. It was so funny. They're like, what if something happens to this manager in Kansas City? How are you going to find to manage it? And we were just kind of like, the yellow pages? A lot of times we go on some of these stages and we talk like we created something, but really it's an industry that's just as old as time, right?
I mean, it's shocking. There's more. When I learned this fact, there are more rented 1 to 4 family properties in this country, people living in those properties as tenants. There are people living in multifamily apartment building units in America. So it's a bigger asset class. Imagine every multifamily building you've ever seen, you've driven by in your life. There are more people living in single family houses and all those combined. And that's not because they're not an attractive place to live. That's because the market's really big. But the reality is when you drive by a single family house, you don't know if that person owns that property or rents it. And it's not obvious in the same way a multifamily property bill is. That being said, we spent a lot of time early on going to prove out that there are many property managers who specialize in small single family and small multifamily properties in pretty much all the markets across the country. And in the event that one property manager goes out of business or shuts down, that's a very deep market for this. I mean, so many people do this across country, and it's easy to sort of find replacements. But we had to go spend a lot of time proving that out. I mean, another question we had that honestly, bizarrely, despite lots of work, anyone any idea about how much does it cost to maintain a home? Like, what is the cost to maintain your house? Now, if you go to multifamily world, there is decades of data on exactly how much it costs to maintain a multifamily property. And now in the single family world, there's a lot of data on it because we've been doing this for a decade. But if you're talking about 2012, 13, we had literally no idea. We called the National Association of Realtors, we called property management companies, but there is really no data on how much it costs to maintain a home. So we had to cobble this stuff together, figure out what it actually costs to maintain a single family property, what's the life of a roof, what's the life of your washing machine, and figure out what the annual maintenance cost is of that over time and build that up. So there's a lot of things, and when you get something going, you have to go prove out. Once you've done it for a while, then you have a lot of data, a lot of evidence, and it becomes a lot easier to sort of validate that. But early on, we had nothing. We had to go make up a lot of stuff and figure it out the best we could.
Well, like I say, I have a high degree of respect for you. And one of the things that you've always talked about was the accessibility of single-family investment. And you passionately speak about the opportunity to create wealth and that type of thing. And I think when people hear you talking about billions, they think, well, this guy may not get it. Maybe you could share, I think it's where some of your passion comes for creating products in this industry.
Oh, it's amazing. Well, I mean, honestly, you're a great example. I mean, Tim, you're a guy who came out of the military, left and bought a house and decided to renovate it and did another one. It's become very, very successful in your life without really a deep business background or any kind of
I was lost at first.
Background, but you go to Home Depot, you get there at 7 in the morning, you get kind of the discounts there, and you sort of work hard, and it's the type of industry that lends itself towards that. And I'm really proud of that. Like we think of ourselves as really enabling entrepreneurs around the country ourselves. And so there's many more entrepreneurs that we fund than we are ourselves. And these are local people who live in Austin, where I am right now, or live in Tallahassee or whatever market around the country, and they know their local markets and they work really hard. Don't necessarily need to have a college education, but do need to have a good work ethic and a good business sense in order to go buy and renovate properties. You got to figure out what the right value to pay for it. You got to figure out how much it's going to cost to get the construction done and what you can sell it for. But if you have that, there's really no limit of how much you can build your business into over time by just being successful. And so we're really proud of what we're doing, which is really enabling all these entrepreneurs. And over the years, I've met, so many borrowers in our space that have had a lot of personal success, have grown, become millionaires themselves because of, indirectly our products and our financing of them. And it's really satisfying to be enabling a career path in a country where, it's a lot of career paths are not open to people that didn't go to college. But this is something that is open to pretty much anyone. If you want to work hard and apply yourself, you can really have a lot of success. And so that makes me really happy. I'm also happy about the fact that our industry, builds housing and creates a lot of housing for families all over the country. I tell my kids, every month, something like 1,000 families move into properties that Toorak funded the renovation of or funded the construction of. And we live in a world where there's a housing crisis. Banks don't fund construction well in our country. The GSEs don't fund it well generally. And so private capital stepped in to sort of fill that void, and we've done it in a big way. And it's a real issue because housing prices have gone up. It's become less and less affordable for younger people to buy places. I think a big part of that's the supply-demand imbalance. And so by coming up with more dollars to go fund construction and rehab of properties, we're directly solving that. And so I'm really proud of that too.
And so John, you'll use terms like bridge, and the investor out there thinks of fix and flip or the old hard word, the H word.
I don't know what that is.
And then I like that you created this transition loan. And I go back to last year, I interviewed our friend Kirk Carlson at New West, and he was talking about how investors recycle homes. Many a times they're vacant, they're blights in the neighborhood. And so I like that you use that word transition. Mm-hmm. And there's a lot of press out there that says that investors are stealing the American dream. As we sit here today, the home ownership rate is higher than when Blackstone started buying houses.
Yep.
Maybe talk a little bit about where you see home ownership going and the role investors can play at maybe making sure that American dream's always there.
Sure. Well, I think there's a number of levels of that. So let's put that into maybe rehab and then long-term ownership. Okay. But in terms of rehab, I mean, we do lots of loans in Newark, New Jersey, and Baltimore, and a lot of places where, there are properties that are frankly uninhabitable, that after an investor comes in, renovates that property, it becomes a really nice place for families to live. And you're turning a property that is not habitable into something that is habitable. And I think everyone agrees that's a good thing because we're just improving that or re-entering that property back into the market as a usable property. Or we do this all the time. We would take a single family house, convert it into a 2 or even 4 family property on the same lot, which is solving our affordability issue by creating more density on the same amount of land, or converting a townhome in New Jersey or New York City into a 4, even 5 or 8 unit apartment building. So you can get more families and expand that, get more families on the same amount of land. So I think far from taking opportunities away, I think the investment market, especially on the rehab side, and our indirect funding of that, is allowing more properties to be created and entered into the market. So it's really solving an issue, not creating an issue. I think from a long-term ownership perspective, first of all, well before institutions bought a single property in this country, the vast majority of houses, many more people lived in rental houses, generally owned by people who own less than 5 properties, than lived in multifamily properties. And no one seems concerned that multifamily buildings are owned by big institutions or REITs or whatever. But there's something about single family that's kind of deep within our ethos as an American and a part of our culture. But the reality is the vast majority, 90+% of the single family homes that are rented in this country are owned by small investors and not owned by big institutions. And those small investors, like my grandmother, who lived in Norfolk, Virginia, and had a house and owned another house next door, and she rented out and gave her income to use to support herself during her pensioning years. And lots of other people probably know people who rent out a property or left their own house and rented it out for some reason. And this provides a real fundamental need in our country, which is a need for long-term retirement income, which is inflation adjusted. It's hard to get that anywhere else outside of real estate. Real estate also has a great tax advantage. So it's a very attractive place for individuals to invest. And I think I don't want to lose sight of that, because I think the vast majority of the market is dominated by people who are buying properties for their own investment. Normal people.
Right? Yeah. I mean, and so, John, I don't want to get into the proprietary data of Toorak Capital Partners, but interest rates have been very painful for the last 18, 24 months.
Sure.
How are you seeing maybe investors adapt, maybe their buying strategies, their tactics on the ground level?
Yeah. Well, I think a couple things have happened. It's not just interest rates. If you think about the investor buying a rehab property and then ultimately looking to sell it, there's three things that matter. Number one is the cost of the property. So properties got more expensive, so it's harder to find properties that are less expensive. Number two is that interest rates are a lot higher, so it's harder to finance your property. And number three is that construction labor and construction materials costs have all increased. So if you think about all the economics of being an investor looking to buy properties, it's a lot tougher now than it was a year and a half ago, because all your input costs are a lot higher. At the same time, we live in a world where there's almost very little housing inventory in most markets around the country. Rates have gone up a lot. And I think most people or economists, if they're honest, would say they underestimated the stickiness that creates, where people just don't want to leave their home because they're sitting there with a 2.5% interest rate. If they move someone else, they're going to be 7.5% or even 8% now. And so that means there's very little inventory. So if you think about the economic reality, your input costs have gone up, the availability of properties to buy has gone down. And so that means the amount of transactions that are happening in the country as a whole has decreased, because investors can't find deals that pencil out in the same way they did a year and a half ago. That being said, I think long term, we still have an aging housing stock. You have a lot of markets with older properties. There's always going to be turnover and sort of inventory and sales. So there's still opportunities for investors, but it's harder now than it was a year and a half ago. And you have to be a lot more selective. You have to sort of not push a deal, make sure the deal makes sense for you, make sure it's penciling out well, and you're getting a good profit margin, because if you don't have that, you don't have a good deal. So there's still deals to be done. It's just a lower volume than we saw probably a year and a half ago.
As I go around some of these masterminds and things that RCN participates in, and, I'm deeply connected to kind of the grassroots level, what advice do you have? I see this a lot still, John, to someone that may be hanging on to a project from 21 or 22, and I tell them to bite the bullet. Like, you're already chewing on it. What advice do you have if someone maybe has some inventory or left for projects that, they're already bad, they just haven't accepted it?
Yeah. Usually the first bid is the best bid. And I'll tell you, I'm in the process of selling my house. I got 30 people walk through it. No one bid in my house. Obviously, the price too high, so I reduced it by almost 10%, and then I get some bidders. And so, there's a market reality of what things are worth, and you have to accept that and be realistic about it. I think, you have to realize that I think rates are going to be high, personally. They are higher. They're not crazy high, but they're higher. I think they're going to be high for a while. And so there's a lot of thinking that, in a few months, rates will go down, that can refi out, or someone will buy it, or it'll get better. I don't think you can think that. I think you got to realize we have a new normal. This is a reality. This is likely to be reality for some extended period of time, and accept it. And so that means you can't rent it out for a price that covers your interest rate. There's a problem there. So you need to go sell that property or be able to put more equity into it so it does cover the interest rate. If you don't like sale price, it's not like it's going to get dramatically better tomorrow. So you got to move that out. And if you don't, you're going to suffer the carrying costs. You're still paying interest. You're still paying taxes and insurance and all that while you're waiting. So it ends up being a worse deal. So my general philosophy is the first bid's the best bid. Now, you want to go market it, make sure you got a real value and you're getting fair value for it. But just waiting and hoping and ostriching is kind of not usually a good long-term plan.
I was talking to this investor over in San Jose the other day, and he goes, "Hey man, when are you going to bring back the 100% 80 LTV?"
Yeah, not a Toorak.
I kind of smiled and I go, "When are you going to start paying 80% for new houses again?" He goes, oh, no, this is for a refi. I'm like, yeah,
Yeah.
I bet it is.
Yeah, not in my company.
And I got another email the other day, somebody complaining about the 11.9% interest rate. And when I got into this business, there were local H lenders that were loaning money at 18 and 4.
No.
12 and 4 is recent as 6 to 7 years ago was still fairly common.
Yep.
18 or 11 or 12 and 1 historically is still a really good rate.
Well, I think the borrowers right now, first of all, no one likes paying higher interest rates, and so it's painful. The fact is our Federal Reserve has raised interest rates by more than 5% the past year and a half. And so you're seeing a massive underlying increase in rates. And frankly, although the borrowers probably don't see it this way, I do, the borrowers are getting a great deal because, the average rate that we would buy loans at probably a year and a half ago was the underlying borrowed coupon was maybe 8.5%. And now it's probably like 11.5%. So you're talking about 3% increase in rates. Underlying rates have gone up by 5%. So borrowers are getting a great deal by historical standards. That margin has shrunk pretty massively. And that's for a variety of it. It means, frankly, lenders in our space are making less money than they did in the past. People like us who end up investing in loans are making less money than we did in the past. But there's a big squeeze. So I think you got to realize the rates today have really improved pretty radically. And they're good by historical standards. Certainly, if you look at the change in rates that have happened versus the change in the underlying short-term rates that the Federal Reserve is offering up.
One of my biggest concerns about my personal portfolio, well, not mine, but as I look at my personal portfolio, my concern for the industry is the increases in property taxes and insurance.
Mm-hmm.
Because I know you didn't do this, but there were a lot of lenders out there in 21 and 22 that were offering sub-1 DSCR cash flow negative loans.
Yeah.
And even if you had a fixed rate, looking at if you have a house in Dallas-Fort Worth, your insurance is 20% higher than it was 2 years ago, and your taxes are 20% higher as well.
Yep.
And which means if you just took a negative cash flow into a awful negative cash flow.
Yep.
What other maybe headwinds do you think? I think those are two headwinds. What other headwinds for long-term rental investors do you maybe not foresee, but think people should be paying attention to maybe in 2024?
Well, those are tough, although there's a positive side to that story, and that rents have probably gone up by more than that. So in most markets, you've had good rental growth, which is more significant than the cost of property tax and insurance. So your income has done better probably relative to what it would have been.
Hopefully balanced out.
Or even more than balanced out. I mean, it probably rent has gone up by more than your tax or your insurance for the average investor across the country. But that being said, I mean, buying properties where you don't cash flow and you don't generate enough rental income to pay your interest is something that's not a good long-term plan. I mean, you're going to come out of pocket every single month to go subsidize that. So either you got to believe that interest rates will go down radically so you can refinance out your loan, or inflation will drive up rent so rapidly that you end up becoming positive, or home prices will just continue to appreciate. I believe any of those three things are likely to happen. Or you're just going to be coming out of pocket indefinitely and subsidizing this project. And it seems like a bad plan to me. So I would not go buy a property for investment purposes that wasn't personally cash flowing positively. I certainly advise investor friends I have not do that either.
So I feel like I've been a little negative. I want to now be positive, Tim. What are some opportunities out there, maybe some markets or things that you've seen some customers doing that you're like, oh, that's smart? Like, where's the gravy at right now, John?
Yeah, I think the gravy is finding something where you see the best deals right now, and I'll give you a few examples, but finding a property that is underutilized in its current state and converting into something else. So it's not necessarily, we used to call it paint and carpet. It's not like buying a property and sort of repainting it and updating the carpet and selling that. It's hard to find those deals that really pencil out because the market's bid up a lot. But, taking something and thinking about not what you look at, but what it could be. So we see deals, and I'll give you a few examples. We see deals in Los Angeles where people take two houses next to each other. There are 60-foot long street lines, They knock down the 2 properties. They build up 5 or 6 different, basically multifamily townhomes on those 2 lots that used to be single-family properties. Once again, creating like more density in the space where there was less density before. Or in Paris and New Jersey, taking a single-family house and converting it into a 4-family property by expanding that, adding more doors, and getting approved as a 4-family property. Or taking properties that are not even zoned as single-family properties. We see this in the United Kingdom a lot, where pubs in the United Kingdom have gone down in popularity. Just socially, it's kind of like bowling alleys in America, and so people will buy those and convert them into single-family properties or even multifamily properties and rent them out. So I think a lot of the best deals take a little bit more work, take a little bit more creativity than they have in the past, but are really finding opportunities to take stuff that's not a single-family property or some other property and converting it into a higher density use than it currently is.
So here we are, 2023. I remember 10 years ago, a lot of the news outlets wanted to call this a trade, right? It was the institutions were jumping in, going to jump out. Obviously, a guy like you has his finger on the pulse. You're acting in a very institutional way, buying billions of dollars worth of paper in this horrible market. Where do you see this industry going?
Well, I think a lot of things are exciting about this industry. I remember, going on panels and being literally the title of the panel was a trader business, and a debate between 2 different sides, a debate whether this is going to stick around or not stick around. And I think now we have publicly traded companies that own single-family rental properties that trade relatively well. And we have a lot of institutions and individuals that are buying and renovating properties and proving that really works really well. I think what's already happened is that our industry has gone from something that was funded primarily from local lenders using friend and family money towards something that's institutionalized, with companies like Toorak coming in, providing really consistent, reliable capital to lenders around the country so that they can lower interest rates, they can do more volume, so you're not running out of capital to sort of fund the deals right now. And that's been a huge change. I think the next thing that's happening, hopefully, is the advent of a securitization market that's rated for our industry. So historically, if you think about, and investors don't think about this, like I used to get my loan from a lender. Really, what's almost more important than that is where your lender gets their money from. And so they may have their own balance sheet or their own money they fund, but that's usually limited, certainly in the scale of the market. So most lenders end up using some sort of institutional capital behind them to fund themselves. It could be a company like Toorak, it could be an insurance company, or it could be the securitization markets. And so what's hopefully about to happen is that those securitization markets in the past have been unrated. And for your listeners that don't care what that means, it actually means something to them because it's going to affect their lives. In an unrated world, it means the amount of people who could buy the loans or the bonds that are ultimately collateralized by the loans is very limited. Only about 10% of bond investors buy unrated deals. And if you convert that market into a rated market, just like we did at B2R and Invitation Homes previously, you have 10x the number of investors who can buy your bonds. And I think the coming of age moment for our industry, where we're really going to become really institutionalized, is once we get to the point to be able to issue rated bonds. And there's one rating agency that's announced some ratings criteria around that. That will hopefully lead to some rated bond issuance in the not too distant future. And that will lead to lower cost of funds, probably lower interest rates for borrowers, and ultimately a better experience for the borrower base. So I think it's something that's the next thing that's likely to happen that's going to be really positive for our market.
And our CFO, Justin Parker, says this all the time. There's a big appetite for this space, right? I mean, you're on the capital side.
Mm-hmm.
Or do you hear people saying, we don't want to invest in single-family investments anymore? Or do you hear, let's get it?
I hear people looking at other asset classes. Do I want to buy Manhattan office buildings? Do I want to buy malls? People like industrial, right? But hotels are really hot right now. But, when you look at around the world and different types of asset classes you can put your money into, the U.S. housing market has shown a shocking and very positive amount of resilience. So it's a good asset class, I think, from a risk return perspective versus other people people can place their money right now. So we see a lot of interest in, capital partners for us, funding us and providing different solutions so we can ultimately provide more capital to the industry and really help grow the industry further.
Very good. We're going to take a quick break and we'll come back. We'll talk to John about the Money Minute and then some more rapid fire. Stick around. We'll be right back.
REI Inc. is a monthly business publication for real estate investors, covering all types of real estate investments and strategies. It is the most comprehensive real estate investment publication on the market. All of the articles are written by the top leaders in the industry, so investors are assured of always getting the best information possible. Each month, REI Inc. also profiles the top companies in the industry and provides insights and data into key regional markets. Along with their sister platforms, the REI Referral Network and Highest Invest, real estate investors have exclusive access to off-market investment opportunities and national acquisition and disposition initiatives. To learn more, visit www.rei-inc.com, where you can also access the REI Referral Network. Also, be sure and visit www.highest-and-vest.com to view the latest exclusive off-market assets with near immediate acceptance decisions and closing strategies. You can also email marketing@rei-referralnetwork.com to request more information.
Welcome back to Uncontested Investing. I'm Tim Harridge. I'm here with John Beacham. John, it is time for the Money Minute. The Money Minute is my favorite part of the show. 60 seconds. The best advice you have for entrepreneurs or investors out there. It can be about investing. It can be about risk management. It can be about being an entrepreneur. I don't care. But it's got to be the go juice. Imagine this is the only advice they get for the next 30 days. You ready?
Sure.
Go.
I think as an investor, when I think about successes I've had and successes other people have had, really the key is to make sure that you find an opportunity that you're excited about and find an opportunity that really is untapped. We live in a country that's so impressive and so large with so many things out there. And so what I tell my kids is become the best in something. It doesn't really matter what it is. You can be best heart surgeon in the country. You can be best person at figuring out a certain kind of esoteric cancer. You can be a person who develops a better dry cleaning fluid that's better for the environment. The list goes on, but find something that you're passionate about that's differentiated in some way that you can become the expert in and really grow your life.
John, I want to take a minute and acknowledge something that I know you've written some articles about, you've been very public about. You want to find a way to make it where the term hard money does not refer to what we do in financing investors. Could you, or would you please take a minute or two to talk about why that is important, not only for you, but for the future of the industry?
Well, it's really about the industry more than me. But if you look at our industry historically, the term hard money has been associated with our space. If you ask people why that is, they'll give you an answer. Either it's always been that way, or we use that term because we finance hard assets, neither of which I find particularly satisfying. The problem with the term hard money is that it has a connotation that doesn't really apply to our industry anymore, about being predatory lenders, about associating ourselves with loan sharks and pawnbrokers, payday lenders, and other not really reputable lending types. The reality is our industry has evolved to an institutional, critical industry that does really important stuff for our country. We have multiple industry bodies with ethics committees, sets of standards. We hold ourselves to a higher standard as an industry, and what we do is fundamentally a good thing. And so I think we as an industry are well served by moving away from the term hard money towards different terms that actually reflect the positive impact we have on communities across the country. Those terms could be residential bridge loans, residential transition loans, even fix and flip loans. I don't really love that term either. But fundamentally, we want to move towards a word that doesn't have a negative connotation in the ears of both consumers or users of our products, as well as regulators and legislatures.
And I agree. And I talk a lot about, I like to piss off my colleagues at these masterminds because they spend so much energy trying to figure out how to send their text message blast to motivated sellers. And then they wonder why the state legislature starts outlawing wholesaling.
Yep.
Right? Where they go around all day putting out bandit signs on the street corner that are illegal to say we buy houses, and then they wonder why the code enforcement officers pissed off at him after he just spent all morning picking up signs when he shows up to give them an inspection.
Yeah.
Right? Like, I think what I hope, because this industry has been very good to me, is that we reach a point to where people appreciate the opportunity so much that they're willing to invest their time, energy, and attention to making sure that this industry is protected.
I couldn't agree more. And I'm an Eagle Scout. I'm a Boy Scout. A lot of people don't know that about me, but I'm really proud of that. And as a Boy Scout, when you go,
Sons are too.
I said 2 boys are also Eagle Scouts.
Told Jennifer that the other day.
And as an Eagle Scout or as a Boy Scout, you go camping a lot. And every time we went to a camping site, the motto was, you got to leave it better than you find it, which means as a Boy Scout, you walk around there, you make sure you fix something or you pick up more trash than you found. But fundamentally, you want to leave it in a better spot than you found it. And I feel like we as industry leaders have the same responsibility for our industry. It's, let's make this industry a better place. Let's improve standards. Let's improve ethics across our industry. Let's improve the way we describe ourselves, the nomenclature, and really elevate the place so we can all leave it into a better place than we found it.
John, I can think of no better way for me to end this podcast. That was a very good answer.
Thank you.
I'm impressed. Always I'm impressed by you. So thank you for your leadership in the industry. Thank you for your friendship. I'll give you 1 minute, just parting thoughts, parting shots.
Yeah, well, I really appreciate being here. I'm at the MPLA conference in Austin, Texas. So it's really great to be here and meet so many people here at the association. This industry has been really good to me. I have so many friends here, you, Tim, many other people I work with and have worked with in the past. And so I'm just really thankful for the opportunities this industry has given me and my company and the ability to continue to grow and provide capital to really solve an important need in our country.
Well, John, thank you for what you do for us, what you've done for me in the last 10 years. And here's to another 10, buddy.
Great. Thanks, buddy.
All right. Thanks for being here. We're out of time. Thank you for stopping back by. Remember, your network is your net worth, and today you've been growing both. We'll see you next week.
Thank you for listening to Uncontested Investing. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow REI Inc. magazine on LinkedIn and Facebook and RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time.